Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand what we currently see in the overall global landscape around the world, and also how we're currently positioned, and more importantly, if we are going to be making any significant changes within our managed accounts currently. You know, the economy still keeps sputtering along. We have a slow growth economy in the U.S. There's a few indicators that are picking up just a little bit. But generally speaking, you know, the GDP growth as we get into the fourth quarter this year is probably going to be somewhere between 1.5, 1.75, which of course is slower than what the U.S. economy really should be doing, and also really slower than what we need to really create meaningful jobs. Job growth ultimately is going to solve a lot of issues in the U.S. Of course, we have the fiscal cliff, which is the raising of taxes at the end of the year. I think ultimately that will be handled by our government towards the last minute, but ultimately I think that's going to be solved and it's going to be fixed. With in the world economy, we start to see a little bit of green shoots coming out of China. Things are stabilizing a little bit. Of course, Europe is in a very slow recessionary environment. Not terribly bad, but it's bad. And generally speaking, when the bad news becomes good news, and we're starting to see some of that. Now, we've had a little bit of a market sell-off in the last week and a half, maybe 3%, which is pretty mild and pretty small. Nothing goes straight up, nothing goes straight down. And as I've talked many times, not only in my radio show, but my TV show, I believe ultimately smart heads will prevail when it comes to investing. We're going to continue running our detailed investment strategy, which continues to include gold, small cap, large cap emerging markets, and large cap within the U.S. I ultimately believe, as I've talked before, emerging market bonds, which we do have a major exposure in all of our client portfolios right now, have the really potential to be one of the outperformers in the bond market over the upcoming quarters. I ultimately believe as the emerging market economies continue to grow, but also maybe want to grow just a little bit better, they will look at reducing interest rates. And when you have higher interest or higher currently paying bonds in the emerging markets, they reduce rates. Of course, that's capital appreciation. When rates go down, bond values go up. So total return, I think, on emerging market debt is going to be far superior on a total return basis than, let's say, U.S. Treasuries. I still firmly believe one of the biggest risk assets long-term, not necessarily in a trade environment, but long-term, is going to be long-term government bonds. Given the 30-year low in long-term interest rates in government bonds, U.S. government bonds that is, I think we are going to see a lot of investors who unfortunately loaded up the boat there are really going to be sorry the next 2 or 3 years as the economy kind of muddles along and maybe we start to grow a little bit. Inflationary impacts will have an impact on interest rates. While Ben Bernanke says he's not going to raise rates until 2015 now, I think that's one of the things investors need to realize, that eventually a rising interest rate environment against long-term bonds that are at historically low yields can have a very devastating effect on the valuation and also the return of certain types of bonds. Now, when I talk about fixed income, and I've talked about it a lot, there's various sectors of fixed income, and some do better than others and some don't do quite as well. One of the areas, and I've repeated this for probably almost a month now, I believe high yield bonds or junk bonds should be at this point reduced exposure or eliminated depending on the risk preference of the individual investor. Within our managed accounts, we've greatly reduced risk exposure to high yield bonds. And I know we have a lot of radio listeners that listen to our updates, and I believe high yield bonds or junk bonds are really trading at a far premium than what they should. Ultimately, if an investor is trying to earn dividend and or growth, I ultimately believe a less risky trade would be some of the equity markets around the world, including the U.S. So I believe high yield bonds are destined to underperform simply because, in my opinion, and based on valuation, they're grossly overvalued. And that's why we've reduced our position in those. Our portfolio and our global tactical obviously is made to be designed to be flexible and go anywhere. And again, I've talked earlier about where we're at in various sector exposure. One area that we may be adding towards the end of this month will be China. We're looking at that closely. It is coming up in the rankings, and it's actually towards the top of our ranking right now in our individual sector for country. I think China, and I think a lot of the emerging markets, are going to shock people as we get into the next couple years. A lot of the emerging markets have underperformed U.S. equities while emerging market economies are growing substantially faster. So what happens typically in sectors is when things kind of lag, they often catch back up. So I would expect that out of some of the emerging markets, and currently we are well diversified in some of those emerging market sectors, not only equity-based, but as I made a comment earlier, debt-based or bond-based. If you are a client, you have questions about your portfolio, please call our office. We'd be more than happy to answer any of your questions. And of course, if you're not a client and want to become a client, call our office for a consultation. There is a difference. We invite you to experience it. Again, till Sunday's show, make sure you do tune in. We've got some great topics. We're going to talk about not only the economy, but the investment markets. Make sure you have yourself a safe and profitable week.